Hey everyone, I'm Ross.
I'm Sarah.
Today we're going to be talking about mixed purpose loans. What's a mixed purpose loan and why do we care about it?
So a mixed purpose loan is when you borrow money and it's applied for both income producing purposes and non-income producing purposes. And now it can get pretty complicated because when you actually repay the loan, you have to apportion it based on the purpose of the loan. And that's why it can get really bad in that sense.
So effectively, if I borrow to buy a rental property and the rental property costs $600,000, and then what I also do, I've got a little bit of extra capacity and I borrow 80 grand to go on a holiday, or 80 grand to buy a car.
Yeah, so that would be private.
Yep, so I've now got a $680,000 loan, so what happens then?
So you'd have to repay the money for the income producing purpose that you've used the loan for, and that, I guess that would, the calculation itself can get really complicated and messy.
So if I've got my $680,000 loan, what happens if I go, oops, I borrowed $80,000 for my car and I repay $80,000 onto my $680,000 loan if I fixed it up?
Well, not quite. I don't think you've probably only repaid part of it. You're not actually,
So on that loan, you're looking at about, let's pretend it's 90% of the loan is business, 10% is private. When you repay that $80,000 onto the $680,000 loan, 90% goes against the rental property debt, and 10% goes against the car debt. So forever and a day, our mortgage has now got two purposes, and the ability to trace that is cumbersome. And we also lose tax deductibility on the original loan, even though you try and repay it. So I guess what we sort of look at for mixed purpose loans is that we don't want them. You want a single loan for a single asset, because when you borrow money, the tax deductions on a loan follows the purpose of the loan. So if you borrow money for a rental property, it's tax deductible. If you borrow money for a family home, it's private in nature and it's not tax deductible. What happens when the asset changes? So what happens if the family home becomes a rental property?
Well, then it becomes income producing. So the purpose of the loan then changes.
So in that case, you'd have a private loan that is now generating income. So the private loan is now tax deductible. So even if you've got a private mortgage, you can't just draw down for cars or holidays or other purposes on your private mortgage. Because in the future, your private mortgage, actually, you might choose to rent that family home out. So what we do want at all times is every loan has its own purpose, and we can actually identify the purpose associated with every loan. What about offsets? What happens with a mortgage offset account?
I'm not too familiar with that.
So with a mortgage offset account, if you have a loan to the bank for $600,000, and if you've got cash in the offset for $600,000, what the bank will do, rather than pay you interest income on your cash deposits and charge you interest expense on your loan, the bank will choose not to pay you interest on your cash receipts, and they'll choose not to charge you interest on your loan. So you fundamentally don't incur any interest on your loan, but you don't get any interest on your cash. And given that you would typically pay the bank 3.5%, and typically the bank will pay you 1%, you're going to save 2.5%. The benefit of a mortgage offset account is that the original purpose of the loan is intact, even if you do have a linked mortgage offset account. So if you take the cash out of that offset and put it somewhere else, the original purpose of the loan is still there. So if you've got a family home for $600,000, your mortgage is $600,000 and you've got a $600,000 offset account, you choose to make the family home a rental property, you can take the cash out of that mortgage offset and put it onto another mortgage, and the original purpose of that mortgage on the family home is now income producing. So you can then move your mortgage offset around to the family home, because what we often find, we've got a very mobile workforce, and a lot of people in that mobile workforce will move from home to home to home, and they'll keep each family home as they move around. So if you've got single purpose loans for single purpose properties, preferably interest only, and you then put all your mortgage repayments into your offsets, you can actually move around and keep the private debt as being fully repaid, and then keep maximising the interest deductions on your other mortgages within the family group. If I've got $1 million loan and I'm incurring 30 grand in interest, what's the real life advantage in terms of making that tax deductible or not tax deductible?
So you've got a $30,000 interest. If that's tax deductible, that full $30,000 will be deductible to you. But if it's not, then you'd be paying double of that, and that's not ideal, I guess.
So,
a lot of money, 60 grand.
So you'll need, if there's someone on the top marginal rate, which
Yeah.
is quite a lot of our clients, you need to earn 60 grand to pay the 30 grand in interest.
Yeah.
So effectively, as you said, you're doubling the cost of the interest. So getting that clarity of interest deduction against the loan is really critical.
Yeah.
Importantly, the tax office actually have a ruling out about mortgage offsets and how they're allowed. So some people think a mortgage offset is some kind of tax avoidance scheme, and it's important to note that the tax office have released a ruling. It's tax ruling 93.6, and it actually allows the use and shopping of your mortgage offset account against the different purposes of loans. And the other thing I guess that's important is with all these different loan purposes, there are facilities that the banks offer where you can have segmented loans within one overarching loan facility. So while you might have an overarching loan facility of 3 million, you could actually have 14 sub-accounts within that 3 million, where the 14 sub-accounts all have individual purposes that you can track. And you could then have 14 offset accounts where you mix and match. Because what can then also happen is if you sell an asset and you take the cash and you put the cash into your super fund, you still need to repay the original capital on the mortgage. You don't have to repay the profit on the sale of the asset, so you could sell the asset, make a profit, repay the capital on the mortgage, but then keep the profit and use that in whatever way that you want. But if you don't have a clear tracing, naming your different sub-accounts to their original purpose is really critical. Because it gets really complicated to review, and then that ongoing document and sort of governance in terms of what all these accounts mean and relate to, because someone's got to be able to figure this out. And if you pass away, your executor's got to figure out what you're doing.
So it's important to get it right from the start.
And if you get your loan facility that's tax deductible, you're going to do significantly better off, because you can just see on a simple case, 30 grand cost versus a 60 grand cost. So if you do have a mixed purpose loan, so you got one loan that covers 6 purposes, is it all over, Red Rover? Can you never fix it?
You can fix it, I think. But it's not without a bit of hard work there, because obviously it's six purposes. It's confusing. But
so there's also tax rulings where you can actually refinance that loan, separate it out, but you've got to be really careful in the documentation and tracing. So internally we call it like unscrambling an egg. Right? So you can unscramble the egg, but it is complex, and sometimes what we find is that the theory is easy but the practice is hard. And actually tracing through the original purpose throughout the entire course of the loan repayments takes a lot of evidence to unwind, because it is significantly more than just keeping an Excel spreadsheet of what each amount related to. It's actually looking at the transactions and the bank statements, and then the correspondence with the banks and the brokers and all that evidence to build up and getting an understanding as to what loan relates to what. What also happens if you're borrowing to pay interest, you can't get a tax deduction for borrowing money to pay interest on a loan. That's called capitalised interest. So it does build and get more complex, but fundamentally what we can do for a lot of people is that we can focus the repayments on their overall debt to the family mortgage and get the family mortgage paid off more quickly, which is what it's about, because a lot of family businesses, getting the family home paid off is one of the primary drivers of that. The purpose of the business is to get the mortgage paid off. So we help a lot of people in doing that, but you also need to talk to your finance brokers to get some clarity on the loan products available. Because some of these loans might be too expensive for a family, and there might be other ways to do the security mapping as well. So, okay. Thanks a lot, guys.
We'll catch you in the next one.
Bye.
Bye.